Hey guys, today I would like to discuss on the seven different aspects around the financials which one should ideally look into before investing in a company. Let's look into it. So as you see, there are seven financial aspects that I prefer to look into while analyzing any company. The first one is the cash conversion cycle. Second is cash return on invested capital, which is also sometimes represented as CFROI. Then enterprise value by EBIT, free cash flow by sales, free cash flow by short-term debt, inventory turnover, and due point ROE. Right. So let's look into it one by one. So the first one is cash conversion cycle. So as we know, cash conversion cycle is equal to days inventory outstanding plus days sales outstanding minus days payables outstanding. It gives insight as to how efficiently the business manages its cash. Every company's goal is to turn cash over quickly. Entire cash conversion cycle is a measurement of management effectiveness. So the lower the figure it is, the better. It's a great way to compare competitors. The cash conversion number is a relative number. You can't look at a single cash conversion number and determine whether it's good or not. A frame of reference is required. That reference is the historical averages as well as the industry competitor cash conversion numbers. One should look for trends where cash conversion number is decreasing, and one needs to be cautious with big increases as it indicates possible cash shortage and inventory issues. Let's look on the second one, which is cash return on invested capital. So generally it's calculated as free cash flow by invested capital. It's a variation of return on invested capital. It focuses on returns made with free cash flow instead of net income. This lets us know how well management utilizes the cash that isn't part of the business. It's a great way to measure the skills of the managers. While calculating the investment capital, generally we take into shareholders' equity, interest bearing debt, short term debt, and long term debt. Cash return on invested capital shall be growing or be consistent. Companies with negative free cash flow will obviously show negative cash return on invested capital, and then at that point of time, this figure would not be of much use. The third one is enterprise value by EBIT. So, enterprise value by earnings before interest and tax. Since EBIT is not an after tax number, you can use it to compare across industries. You still need to take a look at industry and historical averages though. The fourth is free cash flow to sales. So it's a simple metric that tells you what percentage of sales is converted directly to free cash flow. So the higher the figure it is, the better it is. Any company that has a free cash flow by sales ratio higher than 10% is considered great. It tells you that the company is very profitable and has strong operations. They generally hand out dividends with ease and they reinvest and seek other opportunities. Next is free cash flow by short-term debt. This to see if debt can is be easily covered even if it is going up. The free cash flow to short-term debt ratio asks the question whether the company can cover its short-term debt with free cash flow, not by borrowing or diluting, but with internally generated funds. Debt isn't always a bad thing. A company may take on debt to cover short term difficulties. The key is identifying whether the debt is for a broken business model or whether it is manageable and only a temporary setback. So, if free cash flow by short term debt is below 1, the stock doesn't generate enough free cash flow to cover its debt. If the ratio is consistently below 1, there is a high chance of trouble. If the ratio is above 1, the debt can be covered without having to borrow more. Then comes the inventory turnover ratio. So it's as we know, it's sales in by inventory or cost of goods sold by average inventory. The inventory turnover ratio measures how quickly the company sells its inventory. The higher a company's inventory turnover, the lower is its number of inventory days. The goal is to quickly turn inventory into cash then reinvest the cash back into inventory, and then turn it to cash again for even more profits. The more your company does this in a single year, the higher the efficiency and profitability. An inventory turnover of 9 means that the company has gone through and sold all its inventory 9 times during the period. When you use inventory turnover, you need to make sure that you are comparing with similar companies. A turnover of 2 is horrific in the retail industry, but for a heavy machinery, it is excellent. Make sure you're comparing apples to apples. A high inventory turnover can be achieved by tightening the inventory management, which is excellent, and it can also be attained by reducing prices to quickly sell, which is bad. So we cannot blindly accept a number. We have to ask ourselves why this sort of a turnover is actually happening. A good way to see if a company may be boosting sales by cutting price is by examining the trend in profit margins for the firm. And the last one is dew point ROE. Dew point ROE, as we know, is net income by sales into sales by total assets into total assets by shareholders' equity. So to understand dew point ROE, we need to understand ROE first and what is its downside. Return on equity is a financial ratio that shows you how well the management has created value for shareholders. Return on equity, as we know, is net income by shareholders' equity. A high ROE generally means that the rate of return on shareholders' equity is going up and that the company is doing a good job of growing profits without adding new equity into the business. A high and consistent ROE can signal that the company has a competitive advantage over its competitors. But the downside of ROE is that unless a company does not raise additional cash, the company cannot grow earnings faster than the current ROE. However, companies do raise additional cash and it comes in the form of debt or equity. Debt causes an increase in interest payments which lowers net income. Cash through selling more shares lowers earning per share since the number of shares outstanding has increased. These effects are not captured in a normal ROE calculation. So, dew point analysis dissects the ROE to tell you how the company is achieving its ROE. Is the company increasing margins? Is the inventory turnover increasing? Or is the leverage being used? So, if ROE has increased due to an increase in net margin or asset turnover, it is a very good sign. On the other hand, it is the equity multiplier doing most of the work in ROE, then it is a sign to watch for. So these are three version dew point ROE calculation. As you see, there are three parts to it. It can be broken down into 5 steps dew point as well for a better understanding around things. So the objective is really not to take you through uh, a theoretical understanding as to what these ratios are all about, but just to give you a essence and feel as to what I feel are the typical financial aspects that one should. These are the bare minimum ones. I mean to say, this is just a first level of understanding of a company. If you want to get a hold of, these are the elements which will give you some sense. Then obviously you should look much more and much deeper into things, right? So this is just a quick refresher sort of a thing. I'm pretty sure you must be aware of those ratios and what it conveys, but this is just a high level refresher just to uh, give you a sense that these are the aspects that ideally one should look into and how it needs to be looked into, right? I hope it adds value to you, and we'll see you in the next video.